Hey everyone, my name is Dr. Danny Firth, and I wanted to talk today about understanding depreciation from the point of view of a passive investor. But before I jump into that, I just want to tell you a little bit about kind of who I am, my background, who's Chavis Capital, who's the multifamily MD, and how I got here. Um, so I am a full-time family medicine physician. I finished residency and started working full-time almost 10 years ago now. And I work as a hospitalist. So I work 7 days in a row and then I'm off for 7 days in a row. And so that's given me some flexibility on those weeks off. So when I'm not, picking up extra shifts or chasing after my two little boys, I have had some time to pursue some other endeavors. And I got really interested in investing in multifamily about 5 years ago and, started learning a lot about it. And then over these past 3 years have really gotten into the weeds and have started investing in some more syndications and have just developed a lot more relationships. And, one of those relationships was with a gentleman named Brian Chavis. And, he has been in the multifamily business for 20 plus years. He's written a couple books. The most famous one is Buy It, Rent It, Profit. He's got a blog, and so he's really knows what the heck he's doing. And so he has started Chavis Capital, and I am a principal in Chavis Capital along with a few other folks. And so that's kind of the background on how I got here. And so now, I want to just talk a little bit specifically about why I chose passive investing. So to be honest with everyone, I got into this thinking I was going to buy apartments myself. I was going to go out and buy a 5 unit or a 10 unit apartment, run it myself. And I started like most people with single families and bought a couple of those and realized pretty quickly that I was not a big fan of being a landlord. It just didn't really fit my personality type. I mean, it's not like that labor intensive, but there is some things you have to deal with, and I just didn't want to do that. And so that's how I got a lot more interested in being a passive investor. And so as a passive investor, you basically write a check or send a wire, and you trust that the general partner who is actually running the property knows what they're doing, and then you get a distribution every month. And so that is what I've started doing over these past few years, and it has really worked out pretty well. Especially now with the stock market going down like it is, watching your portfolio lose 25-30% is pretty terrible. When it comes to real estate, that typically does not happen with this asset class. So, with multifamily, you write a check for $100,000, you get a distribution every month, somewhere around 6 to 8%, typically, sometimes a little more. And that's what you get. And then at the end of it, when they sell or refinance, you get your initial capital back. And so you don't lose money. And right now, I think a lot of us that have 401ks, it's painful to watch them go down. Especially since you don't get any cash flow from those, I mean, the exception is obviously dividend paying stocks, but still it's not 8%. So that is really just how I've become, a lot bigger proponent of cash flow investing, and then also investing in assets that just don't lose money. I think that was one of Warren Buffett's rules, don't lose your initial capital was rule number one. And rule number two, I believe was, don't break rule number one. So if you can just keep your money growing with time, then, things are going to work out a lot better for you. And so that is just kind of a little bit of a background. And so we can get into, the specifics of, what I wanted to talk about. And so what I'm going to do is I'm going to shut off the video. So, and then we're just going to go through these slides. All right. So what is depreciation? Just from kind of a 10,000 foot point of view. And so, this is a general formula for depreciation. So this can, it doesn't not specific to multifamily, but basically it's this depreciation per year equals the cost of the asset minus the salvage value divided by the useful life of the asset. And so, when it comes to multifamily, the cost of the asset is, how much you paid. So pretend you paid $10 million, for an apartment building, and then the land value was worth, we'll say, 3 million. So then at the top here, you get a $7 million figure, and then you divide that by the useful life of the asset. So when it comes to multifamily, that's 27.5 years. So basically you take 7 million divided by 27.5, and then every year you can deduct that amount from how much the property is making. So it's, it's basically like a phantom expense. And so if you have a commercial property, like an industrial complex, something like that, an office building, the useful life is 39 years. So it's just a little bit less per year. And then there is a way to speed this up. And we'll talk a little bit about that later, but there's something called cost segregation, where you can speed up the depreciation to a lot sooner than 27.5 years. And there's also bonus depreciation where you can speed it up even faster than that. All right. And so what I'm going to do is I'm going to open up an Excel file, and I'm going to go through an example, and this is going to be pretty busy. So the point here is, not to really get bogged down in the details, but really just to try to understand the general concepts. So this is a hypothetical example where, we are buying a building for $10 million. And then there's a lot of assumptions. So you got closing costs, you got to go in and cap rate, NOI. So, all this I wouldn't worry too much about, because it's really besides the point for depreciation. But basically, you go down here and you say, okay, as the individual investor, I want to put in $100,000. How much taxes am I going to pay, on this specific deal? And so obviously this is a fictional property, and clearly I am not an accountant. So, this is just for educational purposes. But here we go. So, all right. So year one, the property made $625,000. And then obviously you have to pay your principal and your interest. And so that your cash flow after debt service is 218,000. And so right here, the depreciation expense is 290,000. And so you only have to pay $8,252 in income taxes for the entire property. So the implied tax rate is really quite low. So you, as the individual investor, year one, you're going to make 5,951, and then you're only going to have to pay $225 in taxes, which is pretty dang low. And this is assuming that, your income tax rate is 30%. For a lot of us that are W-2 employees like myself, that's pretty close. Mine thankfully was a little lower than that this year. And then capital gains rate, 15%, depreciation recapture tax rate, which we'll get into in a second. But so basically that goes on, year one, year two, year three. And so you're making more money. So you're going to pay a little bit more taxes as the property goes on and it's run better and the NOI increases. And then here is where it gets a little bit interesting. Year five is when there's something called depreciation recapture. So, you get to depreciate a heck of a lot of money every year, almost $300,000, from the whole property. But then at the end of 5 years, you're going to sell the building. And so you're going to have to pay some of that back. And so the way it works is all the money that was depreciated over the life of the building. So, for this one, it's 290,000 times 5. And so you take 25% of that. And so that is what the depreciation recapture rate is. It's maxes out at 25%. So it can be a little bit lower if your ordinary tax rate is a little bit lower, but just for all intents and purposes, 25%. So you're gonna have to pay a lot bigger tax bill in year 5, but still, it's still only 11.68%, and so that's not bad. And so it's a lot better than 25%. So that's and then this one, the equity multiple is 2.81. Cash on cash, post-tax internal rate of return. So, so that is that specific example. All right. So now that you've seen a pretty detailed example of a hypothetical depreciation example, what I wanted to do was go through a example from my actual life. And so these are two separate investments that I actually am in right now. And one of them is Celsius. So if you guys don't know what Celsius is, it's a online savings account for cryptocurrencies. So you can save USDC, Bitcoin, Ethereum. In my case, I just have stable coins on there with USDC. And so right now, stable coins are returning how much? So USDC is 7.1%. And then also I have a syndication. And so I am going to go through two $75,000 examples. And these are ones that I've actually done. And so these are real numbers. And so I'm just going to kind of go through these with you. All right. So for Celsius, I have put in $75,000, 7.1% equals 5,325. So that's how much I made. And then so obviously I have to pay taxes on that. So my tax rate overall was 25%. So I got to keep 75% of my money. So out of that 5,325, I got to keep 3,993. So if you take 3,993 and then you divide that by 75,000 that I invested, you get the what is my real after-tax return. So that was my real return. So not bad, but 5% doesn't sound nearly as good as 7.1%. But you just don't think about it until I had to write the IRS a $30,000 check. Then I thought about it for sure. All right, and so this is a syndication that I did with this group out of North Carolina called Ashland Green, and same dollar amount, 75,000. And right now they are distributing $430 a month. So 430 times 12 equals 5160. So 5160 divided by 75,000 equals 6.8%. And this is a little bit lower than the projected returns, and that's because we're still pretty early in this syndication, and this particular one's a value add deal. So a lot of times what you'll find is the returns will go up because in the beginning, they're doing some renovations, they're bringing the rents, up to the market rates. And so a lot of times the returns might be a little bit lower, but 6.8 is still not bad, especially just for a few months into it. And so for this one, they are doing bonus depreciation. So my effective tax rate is probably going to be basically 0, but let's just pretend like, maybe it's going to be 5%. So I get to keep 95% of my money. So that means I would get to keep 4,902. So 4,902 divided by 75,000 equals 6.5% real return. So that is, clearly better than 5.3%. And then, one other example in the title of my talk, when a 7.5% return acts like a 10% return. The point of this was, what if you had, 100,000 and you were making, 10%. So that would mean you would make $10,000, right? And, assuming you're in like about where I was, 75% tax bracket. So that would mean that you would get to keep 75% of your money. And so out of that, you would get to keep 7,500. So your real return, on this one, equals 7.5%. Versus if you had this in a real estate deal and you were making 7.5% and they did bonus depreciation for, realistically for the first few years, you probably wouldn't have to pay any taxes at all, at least until you ended up doing depreciation recapture. So, it's a big difference. And so that was, really all I wanted to get into was just to kind of illustrate in, real life, how stark a difference it can make when you take taxes into consideration. All right, and then what I'm going to get into here is, what is bonus depreciation, depreciation recapture, and cost segregation. And so cost segregation is where these all start. And so what cost segregation is, it's basically where you hire a firm to analyze your property. And, I used to think this was only for really big, hundreds of units, but there's companies who will do this for single family homes because it's often worth it. But what they do is they go into the property and they put a value on everything that can eventually wear out. So that is basically everything except for the walls, because, the carpet is going to wear out, the appliances are going to wear out, like everything's going to wear out. And everything has has a set lifespan. And so typically they can segregate out about 25% of the cost. So, if pretend, you bought a building for $1 million, you bought a 10-unit apartment building for $1 million. So what that would mean is that 250,000 of that would be able to be depreciated much faster because they could cost segregation that out. So that would, that would include things that are replaceable: carpet, appliances, blinds, basically everything that is not, attached to the building. And so that is the first step. So the first step is you do the cost segregation study. And then what you can do is, since this Jobs Act passed in 2017, what you can do is you can deduct a lot of that you took out of your cost segregation study really quickly. And so in 2022, you can actually take out 100% upfront. So in that example I gave with the $1 million property, if you did a cost segregation study and you had $250,000 in your cost seg study, you could deduct that whole $250,000 in, immediately, basically, year one when you own the property. And so that is a huge savings. It basically means that you're not going to have to pay taxes probably for a few years. And then and that is going to be slowly phased out. So 2022, you can take out 100%, and then every year it goes down by 20%. So 2023, that number goes to 80%, and then 60%. And then by 2026, it's only 20%. And so then you're back to just regular normal depreciation. So then you can either do, you can go back to your regular, straight line depreciation, like I was talking about initially. And that was where you just, slowly depreciate it the same exact amount over 27.5 years. And then you can still do cost segregation, but it can't, you don't get it all right away. So with cost segregation, the normal way before this Jobs Act, there were certain things that you could depreciate over 5 years. So that would be things that would wear out faster, like carpet. And then there were certain things you could depreciate over 7 years. So, I don't do these studies, so I don't know exactly what it is, but I imagine that would be like appliances. And then 15 years would probably be like, air conditioner units, like things that are like meant to last longer. But you can still depreciate things quickly, just not as quickly as you can with bonus depreciation. So that is pretty much all I had to say about depreciation. And, hopefully this helps. I mean, what I ran into when I was trying to really learn about this is that I would either get an answer from an accountant where they would tell me, oh, it all depends on the specific deal. I can't really give you any general guidelines. Or you would talk to somebody who's a syndicator and they would say, oh, you're never gonna have to pay taxes on anything ever. Um, and I think like most things, the truth is somewhere in between. And I think if you keep your money going into new deals, so one person I know in particular, she has been doing this longer than I have, and what she tells me is that it's at the depreciation recapture when the building is sold. That's when you take a tax hit. And so what she does is she just makes sure she has new investments to offset that. So her implied tax rate is super low, and that's how she kind of does it. But either way, it's if your implied tax rate is less than 10%, you're winning. If you're like a W-2 employee, like most of us, where we're paying 25 to 30%. So that is all the content that I have for today. If you found this video helpful, please be sure to give us a thumbs up. Also, you can leave a comment below and share this video with others. For more information, you can follow the link below to my website, themultifamilymd.com. Thank you all for listening. Have a great day. This is Dr. Danny, the Multifamily MD, signing off.